Good afternoon. We woke up this morning to stock market futures selling off on fears of a looming recession. Given the tremendous amount of volatility, we thought it would be helpful to provide you with our current thoughts on this very fluid stock market. So let's talk about what has happened. The market sell-off started on Friday after weaker than expected July employment data. We saw non-farm payrolls rise by 114,000 versus consensus expectations of 175,000. Additionally, the unemployment rate increased from 4.3% only a month ago is at 4.1%. So this triggered recession fears based on something called the SOM rule. The SOM rule says when the unemployment rate's 3-month average is half a percentage point higher than its 12-month low, the economy is in a recession. So the sell-off on Friday in the US stock market then materialized into a global market sell-off, which has been exacerbated by leverage trades unwinding. The carry trade is when an investor borrows in a currency, particularly in Japan, where interest rates are 0, and then invests in a higher yielding asset, and that trade is unwinding. It is known as the yen carry trade. So the value of the yen currency increases, these leverage investors have to sell assets to cover, and that's creating a self-fulfilling prophecy in equities and other asset classes. So selling begets further selling, and Japan's Nikkei today suffered its worst day since the 1980s, down 12.4%. Additionally, the VIX hit 60 intraday on Monday, which is crazy. That's the third time that has ever happened since the inception of the VIX. We saw that in 2008 during the Great Financial Crisis, in 2020 in COVID, and today. And as a result, US Treasury yields have plummeted. Today, after the open, more economic data was released that showed that the US services sector is actually in a position of strength, and that new manufacturing orders have also increased. So then after this release, we saw US Treasury yields reverse. So really, this just underscores the very sensitive nature of the market right now.
So when does the selling stop? We're watching the volatility index, or the VIX, and other very sensitive asset classes like cryptocurrency to understand when the selling pressure will subside. The VIX reached over 60 intraday, and it's already down to 34 as of the recording of this video, which is a step in the right direction. Ultimately, we believe the economy is still in a position of strength, albeit less strong than it was a few months ago. While the stock market has experienced volatility in the last few weeks, it's easy to forget that we're at levels on the S&P 500 that we saw as recently as May, with the S&P still up over 10% as of the recording of this video. We think the Fed will cut interest rates in September and continue to cut at subsequent meetings. History shows that once the Fed starts cutting, they rarely stop until they're done. Until then, we expect volatility to continue until the first rate cut is definitive. Remember that while volatility can create discomfort, it's a natural part of investing. Importantly, it can offer buying opportunities at discounted prices. This is an environment that we haven't experienced since the fall of 2023. And most importantly, remember that we have a plan in place. As Warren Buffett says, be fearful when others are greedy, and greedy when others are fearful.